We've been kind of going off the cuff and talking about a lot of different things. And so I thought we need to get back to infinite banking and some basics. Banking is the transfer of money, the storage, the use of money. And so how do you take that over? How do you take over that entire thing in your life?
We're talking about preparing for the future. We're talking about leaving a legacy. Think beyond yourself and expand yourself to your family, and know that every dollar you're putting into this is going to return many times over to yourself. That is generational thinking.
Again, back to the 5 Fs. The stance you have on faith, fitness, family, finance. Like, are you asking the right questions? Is that why you can't find the answer? Good morning, Hans.
Good morning. What's going on?
Good afternoon here. Just plugging away, getting some business done. I've been rereading. I like to read at least once a month. I try to Nelson's book, but I've slacked on that the last few months. But before the think tank that's coming up next week, by the time this airs, that'll probably be over, and we'll probably have an episode about that. But I've been trying to reread it again and thinking about, we've been kind of going off the cuff and talking about a lot of different things and talking about the Constitution and farming and all kinds of other stuff. So I thought we need to get back to infinite banking and some basics.
Obviously, you're referring to Becoming Your Own Banker by Nelson Nash. Book that kind of started this all. You can find it on our reading list on the website. It's essentially required reading for doing IBC, because even though the process of IBC is just using your contractual rights within a contract to leverage and gain control of the banking function, et cetera, the man who actually put that into a codified form, he put a system behind it, is Nelson Nash. And so reading that book is, everything else is supplementary to that, because it's not a super technical book for those who haven't read it. It's 90 pages, not 92 pages, and only about 70 of those are like legitimate content. You can read it in a couple hours. Highly recommend starting there if you're looking into exploring this. There's a lot of good books out there. There's a lot of good podcasts, but everything builds on the foundation you're going to get from that book.
Yeah, this book is the whole reason that I got into infinite banking. I think I talked about this maybe in one of the introduction episodes we did, but it just kept appearing because I was reading personal finance stuff a lot. It kept appearing in the Kindle, in the Amazon, like, as not in Kindle, but in the Amazon, like, recommended books for you. And it was always the first one or it'd always cycle back to that. And I dismissed it a whole bunch of times because of the title. And I thought, you can't like become your own banker. And then finally, I just decided to read it. And I think I read it twice that night and kind of blew my mind. It made so much sense and shifted everything I do financially. So it's absolutely fundamental reading, man. Nelson was a genius. He really did some awesome stuff. He was a strong Austrian economist on, I'd say, the amateur level, but probably more studied in it than some of the people who study Austrian economics. So this puts it into action. It's awesome stuff. But we'll talk today about Nelson's 5 principles. When he started out, he had 4 principles, and then later down the road, he added a 5th to it. Those principles are: think long term, don't be afraid to capitalize, don't steal the peas, which is a reference to a chapter in the book, don't do business with banks, and rethink your thinking. The basic 5 thought processes that have everything to do with this. Remember, the infinite banking concept is a process. It's a process of becoming your own banker. Probably the key word there is becoming. You're not going to do it overnight. And the other thing to that is banker. So the banking, like James Nethery always says, banking it just exists. Banking is the transfer of money, the storage, the transfer, the use of money. And so how do you take that over? How do you take over that entire thing in your life? And so these 5 principles, as he said, were like the keys to doing that. And a whole life insurance policy is just the best product we know that we can do it with outside of the standard banking world. So that's just the product. If you created a new product that better utilized all the things we need to have in place to become our own banker, I'd shift. Like, I love whole life insurance. And the more I've learned about it over the years, the more I like it, the more I think it's the foundational asset in a financial life. But it's really just the tool to the process of becoming your own banker. And these 5 principles were the things that he said were the most important in that process. So the first one's think long term. What's that mean to you?
We're very trained to, between social media culture of scrolling and instant gratification, between everything on demand, between just in time inventory. Our culture is geared towards instantaneous satisfaction of whatever you want, whether it's entertainment, food, experiences. And so when one of the biggest things that people have to get over when they're exploring this and want to look into it is, how soon do I do X? How soon does premium dollar in yield cash value dollar out? How soon does my total cash value surpass my total cost basis, the amount of premium I put in? And people are looking at the first 3 to 5 years and anchoring on that point. When in reality, if you could fast forward and you look at year 30, year 40, year 50, you're going to see numbers that are going to be jaw dropping if you do this correctly. And everybody wants to get there, but you have to get there by getting past this idea of the short-term gratification, short-term immediate fulfillment. And that's not to say that we don't get this value immediately when we structure these policies the way we do. We get immediate enjoyment of it. But if you are focused on years 1 through 3, you're always going to be out chasing things. And we're talking about our savings. We're talking about preparing for the future. We're talking about leaving a legacy. Inherently, leaving a legacy is a long-term minded endeavor. Thinking long range is where value is economically, talking prosperity, family, etc. It's just training yourself to snap out of this instant mindset that we're used to.
And I think deep down people know that, because the standard place, when people are thinking about retirement, is, the 401k is probably the most well known, the qualified plans, and so everybody knows that you don't put $10,000 in this year and plan to not only have access to that money, but also plan for it to make you rich today. So people deep down and know that it's the long-term plan that matters. But when it comes to doing something where you're going to utilize the money, we have this short-term gratification idea. And we're in the meme coin culture, and, in the crypto stuff, it's like people are trying to get rich on these pump and dump schemes, and some of them get lucky enough to do it. You had the Trump coin that came out a couple weeks ago or right before the inauguration, where people dumped money into that, made a ton of money, but everybody even involved knew it was going to crash or it was going to come way down, but they were still interested in can I do this and make a lot of money by tomorrow? And really, to long-term sustainable wealth, that's not the key. We've got to be thinking way out into the future. Nelson teaches in his book that we should be thinking multi-generationally. And he talks about his background as a forester, where he was always thinking 70 years into the future. He even says in the book that, in 70 years, he won't be here, and probably neither will you, but that doesn't mean you shouldn't plan for it. You shouldn't plan for not only your long-term benefit, but your family's long-term benefit and the generation after that. And at one point, even says he's thinking, he said this audibly, he's starting to look into the fourth generation, because he had great grandchildren. So he's thinking in that aspect and how he can capitalize and use this process of becoming your own banker to create prosperity for multi-generations. And we need to think that in all areas of our life. Is really not just about this money stuff. It's everything. I mean, even if you're thinking about health, wealth, faith, fitness, you name it, even your friendships, you should be thinking as long-term as possible in all of those decisions you make in life. So I don't think this isn't just a principle for becoming your own banker. It should be a principle for life. Think long-term. Everything you do, what are you thinking about long-term? Is it just going to benefit tomorrow, or is it going to benefit 10 years from now?
Naturally, when you think through financial decisions, when you think through whatever you're doing, it because it's a decision you are making that impacts you, you think about yourself and your current situation. And so it's hard to look forward 30, 40, 70, 100 years, because none of us have been in the future. And it just makes sense, right? I get why you're geared towards thinking about yourself in the moment, because that's what decisions impact. But we are the 70-year future from our grandparents, from our great grandparents, 100 years, right? And so what if you could go back in time to, say, the 1950s, and your grandparents are starting their families, and you could give them some financial advice, some family legacy advice, et cetera. If you could go back then with your current knowledge now, what would you tell them to do that would impact you now? What if your your grandparents had bought Apple stock or whatever? What if your parents had saw the value in Amazon in the 1990s and decided to invest in that, right? And we don't know these things until we have hindsight. Now we do. We have perfect hindsight, but we don't have future vision. Well, the cool thing with the product we're talking about here is that we're talking about a contract with guaranteed growth. And so I can actually look at the guaranteed contractual value 100 years into the future, 50 years into the future. And so I know that I can impart a huge amount of value guaranteed to my family down the road in 50 years. And I can tell you what that number is right now at a minimum. I know it's going to be more. This gets into the policy mechanics, dividends. We're not trying to cover that today, but if you just take our word for it, that I can tell you exactly a minimum floor of how much this specific contract will be worth in 70 years. And those numbers are eye popping. Well, I'm giving that, I could give that gift to my grandchildren because, my grandparents aren't around anymore. Had they done this, had they done what Nelson did and started these policies in the 1950s when he passed at age 88, right? 82,
I think 87.
87. A couple of years ago, 2019, I believe, he left these policies that have been maturing for 40, 50 years, leaving this monster death benefit. And so if you fast forward 70 years from your life and think what you can do make these decisions right now to impact your grandchildren with certainty, how cool would it have been if you could go back and have done the same thing for your grandparents? Does that make sense?
And not just on the passing of the money, but since we're talking about the process of becoming your own banker, like, we're still at a phase, both you and I, that we still need the banks. Like I'm looking at here buying a new house and I still have to get a mortgage because I'm not capitalized quite to the point that I can take that over. But what if in that process we can guarantee that when we get to number 4 here, which we're going to talk about, don't do business with banks, that our grandkids don't know anything besides a checking account if that still exists at that point in time. And they don't have to do business with banks. So we should be thinking about that. It's like the only thing we know is that at some point Christ is going to return, but nobody knows the day or the hour. So what we do know based on our human experience is that time is going to pass. And if you have children, if you're going to have grandchildren, like that time is going to pass. So pretend like it's going to happen. I mean, and plan for it to happen. Plan as if you're going to live forever, but live as if you're going to die today is a great way to think.
Within the whole contract itself and the way that we discuss it, the way we use it, you could think of sort of your shorter term perspective as your cash value, because remember the cash value is the present value of a future payout. But if we're thinking long range, we're thinking death benefit because we're thinking beyond ourselves. We're thinking our children, our grandchildren, or our spouse that we're going to leave behind. That number is huge. People get hung up on the short term. What is my cash value in year 1, 2, 3? If you're thinking long range, you should be thinking, what is my death benefit going to be in year 30, 40, 50? Those numbers are massive when you see the illustration and the way that we structure these policies. But if you're getting hung up on the very short-term cash value, we want to use that. Of course, we talk about how we utilize it, how we leverage it. It's important. We structure it in a way that you can use it soon, but that's not the primary focus. We're thinking long range here. And, let's have a little more emphasis on that death benefit and a little less emphasis on the cash value because we are not just ourselves. We are our families, our children, our us. Think beyond yourself and expand yourself to your family and know that every dollar you're putting into this is going to return many times over to yourself if you are your family. And that is generational thinking.
And that stuff applies to, we've talked in the past about the 5 F's, faith, family, fitness, friendship, finance. And it really applies to all those. If you're thinking long term, we should be taking care of our health now so that we can be around for those generations. We should be taking care of our families and creating those strong bonds. So we're leaving a legacy, because really heritage is probably more important than inheritance when it really comes down to it. And what kind of people are we creating in this world who are going to go out and bring value? So think long term and how your family is creating value for the world. Everything. I mean, fitness, I think I sort of mentioned there with the foods and the working out and the things we do to eat, establishing good, solid friendships, with another group of men or women or whomever that is going to be there for decades and decades. Somebody you can count on, somebody you have real bonds with. Everything in our life, of course, faith. We're definitely thinking long term because I'm planning to live eternally in the next life with Christ. So this applies to all areas of our life. Let's roll into his next one. Don't be afraid to capitalize. A lot of tie-ins here. A lot of ways we structure. If we're just talking about the policy, since this one is a little bit more of capitalizing into the process of becoming your own banker, into the insurance contracts, a lot of people have things, they question things like, well, how much should I pay? I get that question a lot. And the answer is I don't know, because everybody's a little bit different, but it should probably make you a little bit uncomfortable. It should be useful, and it should be meaningful, the amount that you put in, and it should be something that's going to be able to utilize. So when he says don't be afraid to capitalize, like, the more you put into anything in life, the more you get out of it.
We probably say in 90% of our episodes, we're not talking about investing here. This is a savings vehicle. This is economic potential energy. When we're saying don't be afraid to capitalize, we're not saying you should invest your money. You like that. People are so hung up on that aspect of it, but capitalizing is not investing. Capital, I think of it as potential energy. Like we're capitalizing is loading up a spring so that it can go do something else. Capital can be your home. It could be an RV. It could be cash in your safe. It could be an investment. It could be your 401k. Like capital it's a way to acquire a good or service. It's not necessarily money. It's not necessarily an investment. Like the idea of capitalizing, I think of just pushing that spring so that it has potential energy to then go acquire the goods and services you want. Now, I know that that's not a technical definition of capital. I know that you could spend an entire career defining capital and still not really get it to everyone's satisfaction. But capitalizing is not going and investing. It's like when we're saving into this vehicle, we are building up this reserve, building up this potential energy to then go do the things we want, whether that's acquire goods and services, whether that is investing in something else to grow that money. But when we're capitalizing this policy, we're not going out and spending it. We're not just putting in an investment and hoping for the best. We're essentially moving it from one pocket to a more efficient pocket. Like capitalizing is keeping resources within your personal economy. And so not being afraid to capitalize means be willing to pay this big premium, because it's not just out the door. It's not just a budget item, one-way expense that goes out of your economy and never comes back. It's going to return to your family one day, guaranteed, and you're going to get a lot of use and enjoyment and energy out of it in the meantime. So don't be afraid to view this as funding your own family bank. You're funding your personal economy. We got to think a little differently with the verbiage here when we talk about capitalizing. We're used to expenses in the budget. We're used to an investment that we set and forget and don't think about for 30 years. And so capitalizing is just optimizing the capital within your personal economies to then go do the things you want.
Yeah, and you really need to think about what are the things you want to do, and it's based on where you are. I mean, if you're a young kid who's just starting out, capitalizing your policy with large premium might be a couple $1,000s a year, and that's okay. And if you're in the middle of your career and you're making $500,000 a year, your capital expenditure is going to be a lot higher. But at any rate, you shouldn't be afraid to pay that high premium because it stays in your life. What are your goals? If all you want to do is take over the ability to buy cars, well, then you have to have a policy and a capitalization period that's going to be sized right for you to be able to do that in a few years. And you're thinking long term, so you're going to want to continue to be able to pay that and be able to buy probably even more and more things. If you're thinking about passive income in retirement, once again, the more you put in, the more you're going to get out when this thing gets really powerful. And it's going to tie into policy design a little bit. There's a lot of people that talk about the different policy designs. You got what you call 1090, you got people doing 50-50, you got people doing all base premiums. And the point is, don't be afraid to pay premium. Premium is the solution to every problem financially whenever it comes down to it, if you're thinking long range. So don't be afraid to put your money into these. It's only building your own wealth and your own pool of capital no matter what. Stretch yourself. It should be a little bit painful by the end of the year, but not so painful that you're not going to be able to pay other bills, because you can't. When you start this, like Nelson talks about, someday income should equal premium. That's a good goal, but nobody can start there. He even says it takes at least 20 years to get to the point where all this money's flowing into and through policies. But in the beginning, it should probably stretch you a little bit. That's where you should think, like, just enough discomfort, the size of the premium, that that you can still meet your daily requirements of financial needs.
When you're looking at it, and we're talking about the order of operations and filtering money through this system first, I pay a significant premium relative to my income. And I didn't really change our other spending with our family. Like I just reallocated the flow of that capital because I wanted to go in here first. I wanted to get essentially like kind of dam up the river so that I am accumulating what's coming into our life and then I control the flow of it as it goes out rather than just a continuous flow in and flow out. If you're just standing in a river trying to, collect resources, like whatever floats downstream or whatever, or the power of water, like you're not going to really get anywhere. But if you dam up that river and actually control the flow of it, you have the ability to, that is that potential energy where you're pooling those resources. And so when I started to do that, I just put a dam on the money coming into my account. That money flows into my system. I dam it up. I store that potential energy, and then I decide where it goes. And the thing is, the expenses, the things I'm spending money on, those didn't change. I didn't have to make any big cuts or anything. I just understood the order of operations. And we need to do an episode based on a request we got, which was answering this question of how do I find the premium? I want to pay a big premium. I understand what you're talking about. I get all these benefits, but where am I going to find that premium? That'll be maybe the next episode. That's a whole discussion in and of itself, because it comes down to understanding we're not just talking about an expense here. And so capitalizing your system doesn't need to be this austerity where we have to cut out a bunch of things in our life and sacrifice and script. That's the rice and beans model. You sacrifice enjoyment of life now in order to have this possibility of future enjoyment. We're not doing that. And nothing really needs to change. I mean, your mindset should change, but as far as your spending, of course, cut out any wasteful spending. But in general, like, you don't need to really change your life to pay a big premium if you understand the idea that by capitalizing your system, you're just building that dam and collecting it, and you're controlling the outflow rather than letting it just go in and right out.
All right. One of the most important aspects to this process of becoming your own banker and being an honest banker is principle number 3: don't steal the peas. He has a whole chapter in the book. It's the grocery store example, and that's what don't steal the peas means. It's page 15 in his book. In the grocery store example, he talks about being the owner and the user of a particular company. So a grocery store satisfies those needs, and so the idea is, if you owned a grocery store, would you buy your products at another place? And the answer is you shouldn't, right? So you should be utilizing your own store, but you're also not going to take them out the back door, he said. So you're not going to take that money at a discount. When you're buying your own peas, you've already paid for the inventory in the example. So you've paid for it at the wholesale price, and then you're going to purchase it at the retail price.
Mm-hmm.
So the way the way that translates to the process of becoming your own banker is, we're going to utilize this pool of capital that we've built in step 2 there, in principle number 2, and use it to finance the things in our life, whether that be general expenditures, whether that be investments, or if that's passive income in the future. But with the exception of passive income, you need to be an honest banker. So when you borrow that money, you need to pay it back at interest. Don't steal from yourself. Right now, we can access money, depending on the insurance companies, as low as 4.7%, and some of them are charging 7%-ish, I think, for a loan. On the market, you can hardly get that. So the idea is, if you would have been willing to go to Wells Fargo and take a loan, let's just say on a car, and they were going to charge you 8.5%, well, that's the market rate. So pay yourself back with interest and have a plan to do that. Don't steal from yourself. Make sure that you're being honest with your own capital, because why is somebody else's, Wells Fargo in this example, why is their capital more valuable than your own? If you utilize this policy to pay off credit cards, well, they were charging you 24% interest. Just because you have access to money at 5% doesn't mean that you should pay it back at 5%. Now, there's a common question that comes with that. What do I do? What does that do for me if I'm paying it back at 24% and I've maxed out the PUAs? That's what always comes in. What do you think about that?
At that point, you're just going to pay it down quicker. Let's say, I think a car loan is a little bit easier to wrap your mind around because it's a fixed term. So I'm going to switch over to the car loan analogy, but you have a 5-year, 60-month car loan, and you're going to pay back $36,000 on a $30,000 purchase at the current interest, at that interest rate that you get. If you were to buy that loan, buy down that debt with the policy loan, for instance, and your policy loan is 5%, the idea of paying it down quicker, valuing your capital more than you would have valued the dealership's capital, maybe you pay that down in 4 years because you impose on yourself a higher interest rate. Because remember, these are unstructured.
Charging 10% pretty much on everything. So when he took a personal loan. So if you pay back at 10%, for example.
Yeah. And so if you have no more room to pay PUA, and remember, just bring it back to a very basic level for those who are still kind of unsure what we're talking about. These policy loans are unscheduled. They don't tell you when or how much to pay back. The only thing they tell you is the interest rate. But other than that, you pay back when you want to, which is a huge, powerful component to this, to IBC in general. So if you pay it back quicker, you decide instead of the 5% the dealership's charging me, I want to pay myself back at 10% because I value my capital more. I want to put that money back to work. I want to get this debt knocked out sooner. If you decide to do that and you pay back at 10%, let's say you're going to pay back in 4 years. I'm making up the number here. It's not actually, it'd be something different than that, but you're going to shave a year off that repayment timeline, let's say. If you don't have any more room to pay PUA premium, which is the optional component of premium that generates cash value, if you don't have any more ability to pay that based on the restrictions on the policy, whether the way it's structured or because of an IRS limitation, well, then you're just going to stop paying at the 4-year mark. All you've done is you paid it off a year earlier. You replenished your capital. You've refilled that bucket or that hole that you dug. If you do have more PUA room, you could decide that I'm going to continue to pay more money. And if I keep paying this for another 5 years, even though I don't have to, you would be putting that money into your PUA bucket. Essentially, you're increasing the size of your policy. So it's not necessarily that you are paying yourself interest. It's, that's a kind of a misconception from when people read the book, but you are increasing the size of your policy by purchasing PUAs with the additional money over on top of what you have been required to pay down.
And, some of that comes down to what company choice that we have. And the couple companies that we prefer, they are very flexible in their paid up additions. So maybe you aren't maxing those out on the first day of the policy year. Some companies will require that. And then you don't have room to pay more PUA. But maybe if you have the flexible provision and you haven't maxed the year out, that's where that extra interest is going. And if it is maxed out and you've paid off your loan early, that means the money's setting aside, probably in a checking or savings account somewhere. Keep paying it. And that means that if you've maxed your policy out and you're able to repay any loans you have, and you're still saving money, essentially, you are ready to capitalize. You haven't fully capitalized your ability to pay a premium. So it's probably time for another policy, because ultimately, Nelson even says this in the book, that this is going to create a system of policies. It's not about one policy to do everything, because your income is going to go up. So you're probably ready to expand your capitalization. If you're paying it back and you're maxed out already, time for a new policy.
The analogy, I think, in the don't steal the peas, it's kind of conceptual, because you're like, okay, I don't want to steal from my own grocery store, but I can see where you might not connect that to a policy if you don't really understand the mechanics of a policy loan. But part of that analogy and some of the numbers that he gives as an example is, I can't remember exactly the numbers, but I think he said, talking about a can of peas, don't steal the peas. If it costs the grocer, you as the grocery store owner, it costs you 60 cents to buy a can of peas, and you sell them for, say, 63 cents. I can't remember what the number was, but you're making a 3-cent profit margin on a can of peas. That, there's pretty thin profit margins at a grocery store. That's probably pretty reasonable. And now this is pre-quantitative easing, Obamonomics, et cetera. So this was like when you could actually get something for 60 cents. But in 2000, the 60-cent can of peas sells for 63 cents at the store. So if you go into the grocery store that you own and say, hey, I own the store, like it's my inventory anyways, like, I need a can of peas. Why don't I just take it instead of I could go to someone else's store and pay them 63 cents? Why wouldn't I just save myself the 3 cents, take the can of peas, and I don't need to pay it back? Well, if you think about it that way, yeah, you're just taking a can of peas. It's just 60 cents. But if you think about the 3-cent profit margin to make on one can of peas, to replace that can in your inventory, you need to spend 60 cents. So you need to sell 20 cans in order to replace that one can. And that, to me, kind of put the exclamation mark on, I'm not just taking a 60-cent can of peas. I am creating an obligation to sell 20 just to break even on the one that I stole for myself. So pay the full 63 cents, because by doing that, you're contributing to the capital flow and you're making the profitability on that can of peas. You could pay 60 cents and break even on it. And that would be the analogy of like just paying whatever the rate of interest is. You could break even on it by just paying what you paid for it, and you make no money on that, but you want to contribute to the profitability of your grocery store. So you pay the 63 cents. That's kind of how it ties back into a policy loan. you pay the market rate of interest or more. What do you pay 65 cents to that can? Because at the end of the day, 60 cents is going to replenish your cost of goods. Whatever you decide to pay on top of that, you're just providing profit to your own grocery store, which is what you want, because you want to increase the profit margin of the grocery store. In the same way, if we choose to pay it back earlier, where we're just giving the company that's loaning us money, who we are part owners of, profit sooner, therefore we get the dividend.
I think just very basically, like, a lot of people would think, like, why would I pay 65 cents if I'm selling them for 63 cents to the general public? Because it's just more money out of my pocket. And I'm using this grocery store, if I'm pretending I'm the owner, I'm using this grocery store to make my money. So I'm just spending more of my own money on it. But again, it goes back to thinking long term. He's talking about someday most business owners want to sell their company. So they're going to look at the books. And if you've been stealing the peas, your company is worth less when it's time to sell it. If you've been paying more and the company is showing a larger profit margin, the same as it would if you're buying more paid up additions, now your company is worth more. The company in this analogy is the is the insurance policy. So by putting more money in, you're just creating a larger company or a larger insurance policy, which means more capital, more dividends, more flow to you and your family. So it's, again, it goes right back to thinking long term. Yeah, you're paying a little more now, but you're building your own system, your own pool of capital. You're not afraid to capitalize. You're thinking long term by not stealing the peas. All of these consistently tie together.
When we go back to the idea of cash flow, we think of, if I have an investment that's yielding, say, 10%, then I can just throw money into that whenever I want. That is my cost of capital. Anything else should be compared to that. Why would I keep money in X if I can, at a minimum, make this 10% in this investment? So if I have an engine that's churning, whether it's a policy, whether it's an investment, whether it's a business, my grocery store, if this engine, this economic engine is churning, every dollar that flows into it grows the engine and therefore grows the output. When you think like, well, why would I, like you said, why would I spend 65 cents? Why would I pay that 5 cents extra? Well, that 5 cents sitting in your pocket is going to be spent somewhere. It has to land somewhere. The best place that 5 cents can land is in an engine that is intentionally and reliably growing everything that's put into it. And so if we know that 5 cents can either go and be spent on, whatever, you just go out to the market and purchase one thing for you one time, or you can put it into this engine, which is your grocery store, which is your policy. Putting that 5 cents in, it's going to grow to 20, 25, 30 cents down the road eventually and return to your family. And in the meantime, if it's the policy, we can continue to leverage that 5 cents. And so and that gets back to what we talked about before, don't be afraid to capitalize. You're not just spending this money and it's out of your life when you pay premium. You are just capitalizing a system that you own that is guaranteed profitable for you. So why would you not want these dollars to flow in there? Why would you not overpay for the can of peas? If overpaying means you're expanding the engine that's churning out currently and guaranteed in our case with a contract.
The next one is, and Nelson was very hardcore on this as an Austrian, as somebody who opposed the Federal Reserve Bank. We've talked a lot about that in prior episodes, but don't do business with banks is number 4. And a lot of us aren't going to be there. And he even talks about it. It's going to take years to what he said was slay the snakes and dragons to get to the point where you don't have to do, like, Nelson talks about in the latter part of his life, the last 25 plus years of his life, he only had a checking account because you really need it. You have to have a checking account for the convenience of life and spending money on the general marketplace. Unless you're living off the grid somewhere in Alaska, it's almost impossible to not have a checking account. So that's the only business he did, was for flow of money. Once again, don't do business with banks is about taking over that process. Don't be afraid to capitalize. Have your own pool of capital that you can finance all the things of your life. Because, and again, this just keeps going through that entire system. So these all build on each other. If you're thinking long term, someday you're going to build a pool of capital that you don't have to go to the bank for a loan to do the things you want to do. If you're not afraid to capitalize, you're going to build a big enough pool of capital that you can do the things you want to do. When you want to buy a house, doesn't even matter the size of the mortgage. If you've capitalized well enough, you're going to be able to own that mortgage. That money's going to flow to you instead of outside to the bank. By not stealing the peas, you're growing your own system. So someday you can do all that financing for yourself and pay all that money back in yourself. So it's a goal of mine. Someday I'm hoping to never take a loan again.
Yeah, for sure. And in the IBC community, you'll find a spectrum of how people think about this. Obviously, on the philosophical side, as pegged out as you can be on that side of the spectrum would be Nelson, don't do business with banks aside from a checking account. Economically, you're contributing to inflation by taking out a mortgage because that money is created on the fractional reserve on the back of other capital, right? That's what he says. Banks create something out of nothing. That's evil. Like if you go full philosophical with it, you don't want to borrow from a bank ever because doing so contributes to inflation. It increases the monetary supply on the back of the fractional reserve system. On the other end of the spectrum, you would find people, and I could name a few who I trust I think they have really good insight, like who would say, I don't want to remove the option to borrow from banks. You know, if a car loan is 2%, like it was, say, 5 or 6 years ago, and you could get a policy loan of 5%. Well, Nelson would say, take the policy loan because, and all these reasons we're talking about. And it's a philosophical reason. There's other people, even in the IBC community, who I think have equally valid takes that would say, I want to be my own banker so I can make the best decision among the options available. Like if you don't have your own banking system, you have to go with the car loan. But if you have your own banking system, you can decide what's more economically advantaged, put my capital to work elsewhere. And someone would say, well, I've got this cash value that I want to put to work and I can grow it and make 20% in a hard money loan or whatever. Why would I use that money and replace a 2%, car loan that I could get? Like the bank's offering free money. So that's on the more like, dollar for dollar side, but there's a spectrum of how people view this. And I kind of fall somewhere in the middle. Like I don't want to contribute to inflation, but I'm not personally dogmatic enough because banking exists. It will always exist. It's like the plumbing in your house. Like you might not think you're a banker, but you take showers, you run the sink, you have a dishwasher, you have a washing machine. Like you're interacting with this. Like it all flows through the plumbing. Plumbing comes in, plumbing goes out. And if you're the utility company, you're making money on the flow in and the flow out of that water. You interact with it in your house day to day, but you don't think of yourself as a plumber. But if we think of it like the money flows into our system, we do our own things with it above the surface, and then it flows back out. That is what the banks are doing. They're always going to be there. Someone is going to be controlling the input and output and profiting off of it. So you need to become a plumber in the sense that you need to control the inflows and outflows here. But I want the option to decide, does it make more sense for me to invest this money for my policy and just take out a car loan from the bank because it's 2%, or car loans are really high right now. So I want the ability. So I kind of fall somewhere in the middle. I don't know where you're at with that as far as the philosophical to the more practical side of things. Obviously Nelson was on the far end of like, we need to cut this out because it contributes to inflation. And I get that for sure.
The banker's in control. Once you're capitalized, you are in control. You get to make the decisions. So I tend to think of it as like I would take a car loan for 2% from the bank.
Yeah.
But I wouldn't take a car loan at 2% of the bank if I have no cash value, because then I'm not in control. I believe in the side of like you can have debt and not be in debt. If times fall hard for some reason and I've got a pool of capital and I can swipe a check tomorrow to write that or to pay off that car and not have to worry about now the lien against it and the possibility of it being taken away from me, then I'm in control. I'm still in charge of the banking function. I've just chose to use an outside entity. I also think there's a difference in being a customer of the bank. When you take a mortgage for your personal home, or you buy a car for your personal use, you are a customer of the bank. You could also be a partner with the bank if you're an investor. So if I buy an investment home, it probably makes more sense if you look at the capitalization of that to maybe pay the down payment on my own, like most people do, and be a partner with the bank in that investment. So I'm utilizing their money to create more wealth for my family. I'm not using it as a consumer in the same sense. On the consumer side, I would rather not use the banks most of the time. Now I could pay my mortgage off in the home that I live in now, but it's 3%, and I'm not going to. Like it doesn't make sense to pay that off with a policy loan. In the future, when I move, right now the interest rates are way higher than that. I'm going to take over that loan as fast as I can. Probably 3 to 5 years. I will completely purchase the loan of that. I'll be capitalized enough to do so, and I'd rather have that option because I'll be paying less interest and I'll be in charge of those payments. So yeah, for me, it's a function of what makes more sense in the moment financially. It's I'm not quite as hardcore, but I want to be capitalized well enough in the long term to always have the option whether I want to do business with a bank or not. If I want to cut them out of my life completely, I can. And if I want to use them, I can. That's where I want to stand.
Having the ability and adding the choice to pay off a loan or debt that you have outstanding is economically a more powerful position than having it paid off. It's good to not have the debt potentially, but you don't have that capital anymore that you used to pay it off.
And something else in that, the people, a question you get is like people want to they have this idea of like how much PUA can I pay and how much of that can I get immediately? And I personally, I'm a little bit more conservative on that. I don't see like I'm okay. If that's what they want to do, they're the owner, they're in control. They're the one becoming their own banker. But I like to view this as an emergency and opportunity fund. So I have a minimum cash value reserve that I won't go below. That's my emergency fund. That's like the fire's burning and what do I need to do as everything burns to make sure that I'm still secure? So I have a minimum point there of capitalization that I won't go below unless it's an absolutely, break in case of emergency kind of thing, break the glass in case of emergency. So I'm not a big fan of this like idea that like I just want to get the money in and get it right out, like because then you're never ready for the next opportunity or the next emergency.
Yeah.
But yeah, I think there's some talk about that we don't really need to get into on this episode.
It gets into how dogmatic are you about it. And what I want to avoid when I'm thinking through this stuff is like if you're Dave Ramsey, you're backed into a corner of this advice that has not changed in 30 years, even though the market conditions have changed drastically. He was asked, would you take $1 million loan at 0% interest? And because he's so dogmatically against debt, he said he has to say no. There's nothing else he can say. Otherwise, he has to revisit all this advice he's been giving for 3 decades now. And the advice hasn't changed and kept up with the macroeconomic environment. But there is some psychological value. There is like an emotional component to the advice he's giving for a certain type of listener who desperately needs that way of thinking. There are people who should never, ever, ever touch debt until they can get a control and understand how to use it, that it's a tool, that it's not just free money, right? So like there is a portion of the population that desperately needs that. But for someone like you or me to turn down a 0% interest loan would be, if we said no to that, you should unfollow, stop listening, write us off, because that's preposterous. I mean, that is terrible, terrible advice for someone who has any kind of financial literacy. But Dave Ramsey is so backed into a corner dogmatically, philosophically, that he could never take that good advice. Like he could never not give the wrong answer there, because, and that's where I don't want to be. Where if I can go back to an example, if I can make 10% on an investment that I have that I can put money into and grow 10%, and I use that same capital to instead pay down a 2% car loan from the bank, like that's a philosophical decision with no numerical merit, and you have to at least know where you stand on that. And you could justify that decision if you understand the philosophical side, to me, is more important. So, and I think we both kind of fall somewhere in the middle there, which that's where I'd like to be.
That's a great segue into principle number 5, which is rethink your thinking. Nelson added this one later because it really should just always be questioning, like, what is the common narrative? Like you mentioned in the beginning of this, we live in a society of instant gratification. So rethink that. Like, do you need to have instant profits all the time? Which goes back to, are you afraid to capitalize? Rethink everything about what you're doing. Or are you going with the grain or against the grain? We've talked about this one ad nauseum on all the episodes, but it's perfect there because like you're saying with Dave Ramsey, he's been given the same exact advice dogmatically for 30 years, unwilling to rethink his thinking. Like, is that same advice the same? Like, one of the places I started questioning him, because I did the Dave Ramsey, I did the beginning of the baby steps to get out of debt. They worked. It was good. But I was also like reading free market and Austrian economic stuff. This is 15 years ago. And I was a gold fan. And gold, especially at that point after the 2008 crash, if you looked at it from the year 2004, it had far outperformed the S&P. So is
Mhm.
this like, and it's still been going up and it's still been solid. Not that I necessarily am a big fan of like that being an investment, but he was so hardcore against gold. I was like, if you are just talking about the returns and the value of it, it has beat the S&P in this period of time that he was talking about, but he was unwilling to rethink his thinking. And I think that as Nelson's principle, we should constantly be rethinking our thinking, reattacking. Are we asking the right questions? Because the answer is always there. And when you can't find the answer, the thing to go back to is, are you asking the right questions? Is that why you can't find the answer?
Mhm.
So constantly rethinking about the stance you have on everything. Again, back to the 5 F's, the stance you have on faith, fitness, family, finance. Like, are you rethinking all of those things? Like, I think very differently about the fitness side of things and the health side of things. And if you're not rethinking that since the year 2000, your head's in the sand. Like, you need to be rethinking like all of this mainstream advice we've gotten about health and well-being, and vaccines are the sacred cow of the 20th century that have saved humanity. Like, are you rethinking that? Rethink everything. It's such an
Mhm.
important principle. It really encapsulates the first four, but it encapsulates everything in life.
Yeah, our business is a case study in rethinking your thinking. If you could go back 5 years and where I was at then to now, and then for you, I don't know, maybe 5 years ago, maybe a little bit longer than that, because you started kind of learning this stuff obviously before I did, since you brought me on board. But our like Remnant Finance is itself a case study in this last principle. The reason we met was because we had to rethink our thinking on the government, the military, the health system, the legal system. The reason we started working together was because we were rethinking our thinking on finances. And part of having a strong conviction and a strong position is being able to steelman your argument. And so I can go back to where I was thinking before, financially, medically, et cetera, and I can make those same arguments that I made before, because I understand what went into my thinking there. But what I know now is a night and day difference. It's like there's no way that 5 years ago me could could debate current me as far as financial planning, et cetera. Even though I can make all the arguments a CFP is going to make, I could have the conversation that a CFP is going to have with you verbatim without being a CFP, just because it could, one, because it's always the same. It's always the same advice no matter who you are. And two, because it's what I studied for so long. And so being able to understand where your ideas come from. And I feel like now my thoughts on economics are so much better research. They're so much more grounded in reality and actual experience. And it comes down to basing in contract and not in speculation. In the medical side, it comes down to actual, what are we actually seeing, and not what just someone on, was Chris Cuomo telling us to do, on the news or whatever. Or
In this book, Becoming Your Own Banker, that ultimately led to this massive paradigm shift. Like, I always say, this is the second most important book of my life because it shifted the way I thought about everything. Definitely pick this up and read it if you haven't. It's absolutely fundamental reading. But the cool thing about it, rethinking your thinking, and like you're talking about having good grounding, is this book was written 25 years ago and there's nothing in it that's not true.
yeah,
And I can't say the same about the other models and the other ways I was thinking. Even like when I say, like, I was doing the Dave Ramsey stuff and I was thinking that model, like, that stuff falls apart for me now. And it should fall apart for him. And at least some of it. The good thing, I hate that we always dog on him. It's just that he's the biggest voice out there. The thing about it is, if you do what he does, it works. Like, you will pay off debt. You will have more money later than you have now. If you do that, it works. But it doesn't mean it's the best way. It doesn't mean it's the only way. It doesn't mean it's optimal, but it will work. That's why it's stuck. And that's why the message stays out there. It does work. Just, does it work as well as other things? I don't believe so at all. I think I could pick all that apart.
yeah, and you got it. And a big part of that is don't take advice from someone who's not doing what they're giving you advice to do. Like if you want to, if Brian and I both weren't paying, we both weren't thinking long range. If either of us were afraid to capitalize, if we were stealing the piece from our own system, if we were just constantly doing business with the banks, you know, beyond the degree that we need to, and if we hadn't rethought our thinking, you wouldn't be listening to this. We wouldn't be working together, and we wouldn't be where we're at. We're both paying big premium into our banking system because we're thinking long term. We're doing all these things we're talking about. But if you weren't, you should not listen to us on how to think long range, on how to capitalize your system. Like you shouldn't take our advice if we're doing that. Well, Dave Ramsey's wealth has nothing to do with the wealth building strategies he talks about. And so, again, that's not the purpose of this. But like, don't take advice from someone who's not doing what they're telling you to do.
That's right. That's great. Yeah, I think that encapsulates it all, man. So I'm just gonna, just keep reiterating: buy Becoming Your Own Banker. You can get it on our website. You can get it from the Nelson Nash Institute. You can get it from Amazon. I don't care. I just think it's more important that you read it than where you get it. Read it, and if you're a client of ours, read it again. Like, one reading of that book will not is not enough. When you read it again, you're a different person. You're already thinking differently if you've put this in place. So the next time you read it, you're going to take something more from it because you were in a different place at that point from the first time you read it when it was brand new to you. So read that again. I think people should read it at least yearly if you're practicing this concept and you're putting this in place and you're capitalizing your system. Like reread this book every year. Like he said, it's probably 70 something pages of actual material. It's 92 pages total, and you can knock it out in 2 hours, especially if you've read it. But that's awesome. His principles are sound. They're strong. I don't think they can ever go away when it comes to becoming your own banker. Great one to revisit, man.
Yeah, for sure.
All right. So we'd appreciate it if you like, subscribe, if you share this podcast. You can go find us on remnantfinance.com. You can email us at info@remnantfinance.com, or you can just reach out to either one of us, Hans at Remnant Finance or Brian at Remnant Finance. We'll be happy to plug in the system, teach you, answer your questions, help you out, put this practice in place, and it'll change your life. I think everybody needs it.
You owe it to yourself to explore it, vet it for yourself.
Awesome, man. Well, we'll talk again soon.
All right. Cheers.
See you, brother.